everyone, to the Kendall Report, where I share my 46 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, it has been a while, to say the least. And what I'm going to do today, obviously, we're here for the Fed, and then ultimately, we're going to go through some of my overviews of the market since I haven't talked to you for a while, and then we'll see how many folks show up, and there's a good presence here. We'll go through and I'll let you guys run the show and ask questions. So let's get into tonight's video. Okay, folks, haven't been lit up for a while, so it's good to be here. I'm just going to talk about a few things that I will, want to update you on, and just see what kind of feedback we get. But I've been off for a while. I have been dealing with a family issue, and unfortunately, my wife passed away. I was not going to say that, but it's been a very difficult time, actually, the last couple years. So I appreciate everybody. I've been working on getting things together. I'm in a new studio, still got some things to do here. So ultimately, I will be trying to get back online. I'm planning on starting a podcast, which I'm going to be bringing in some old friends from the 80s and 90s. And even some 70s. I have some potential to bring on some very interesting guests. So I'm looking forward to doing that. My intentions at the moment, just to get everybody updated, is not to come back and do daily analysis. A couple things. We have a Discord that I'm planning on getting more involved in and getting things going on over there, and as well as possibly getting into, doing some educational stuff. And those of you, the thousands of you, and I appreciate the business, that have bought the indicators, the WaveTech indicators, I'm going to be starting some plans on doing education there and doing a lot of different things. I kind of want to change things a bit from what I did in the past. And you may have noticed that I talked about 46 years. In September of 1979 is when I started in the market. So the clock keeps moving here. So I'm proud to be able to be here and trying to get life moving forward again. So I appreciate all the patience, and I will do my very, very best to get involved in the community. This is my entire career, and what I've done for all those years is really important to me. So we've got some really cool stuff going. Those of you that get the newsletter have seen the data sheets that I put out. They've been modified a little bit. I'm trying to make them just a touch better, but soon you're going to have ability to use those, and I've got a pretty cool announcement. It's still about a month away. It's gotten to be a much bigger project because I keep coming up with ideas. So let's get into talking about today. Okay, there's a lot of stuff. Markets have just been soaring, and we continue to see. I put out, I think in last night's, I've been mentioning a number which is around 7,100. I think we could reach that by year end. I mean, we've got 2 months. That's a long time in this market, and we'll see. And I'll break this down a little bit. I'm going to go talking about the Fed, since we'll be getting that news in about 15 minutes, and then ultimately I'm going to go in and we'll break down some things about this government shutdown. So let's go ahead and just talk about the Fed for a few minutes as we get set up for that. Don't be fooled. The Fed has all the data they need. I was watching, I have Bloomberg on TV over to the right of me, and they're talking about the Fed doesn't have the data. They have all of the data. Just like we saw all of a sudden CPI gets reported. Why? Because the Social Security people do their annual review, and they needed data. Guess what? They got data. You don't think the Fed gets data, then you're not living on the same planet as myself. I just think it's funny how, and I talked about there is a dark out on all that, but the Fed, they get it, we don't. So they have to say, the kind of the gaslight is here that they have to say that the Fed doesn't get it because we don't get it. And trust me, they have it. And they always have it ahead of time. You folks have heard me say this for years. You don't think they have these reports before this happens. Once again, you're not living on the same planet. So the expectation is quarter point today. I agree with that. I think that's the case. I think we get another quarter before year end. If you go back and through the Kendall report, if you do want to check that out, kendallreport.substack.com, you can get it there. But if you look at some of the things I've been talking about there, it's actually been the only thing I've been able to maintain for the last year, and I've been leaning on some of the AI sheets and stuff to give me the space that I needed to navigate through my life at the time. Some of that will change as I go forward, just trying to get reconfigured here. It's been pretty tough last couple months, I'll say that. So anyway, but I think the big thing, and people are saying it's priced in, there's been a lot of activity in the repo market, and it's pretty obvious that QT needs to end. And I'm going to try to bring back those of you that are fans and been on around the channel for a while. I remember the days when we used to light up. There were 1,000 viewers. Right now there's like 85. So we'll get it going again. It's okay. But the one of the things as we kind of look at what the Fed's been doing, it's pretty obvious that one, they wanted the yield curve to change. That's what this is about. I still think the 10-year, I have it up on the other screen here, is going to hover right around this 4% level. You know, we're looking at right now 399 last trade. It's going to hang right where it has been for the year. You folks have got to be tired of hearing me saying it, but this the back end of the curve is going to stay where it is. If they stop the QT, it might have a little bit of a reaction. They may have already scaled it back. Usually by the time they tell us that they're doing something, they've already done it. It's not as transparent as you think. I think it's most likely going to, like I said, stay in the back end. What we need is a 75 to 1% difference between the front end of the curve and the back. At that stage, we'll see the Russell and other things start to come together, and ultimately, the economy is going to be able to operate better in that steepening environment. It's much better for the banks, the regional banks, the small banks are going to do better. Everybody's going to do better. If we get lending, that will change lending standards, everything. So that's most likely going to be the conversation that we have going forward. So so I think the QT thing hasn't been priced in. I don't know. What I believe that means is that the Fed balance sheet it's starting. The Fed announced, remember, way back in 2020 when they said, you know, they were truly the lender of last resort and took basically a lot of the requirements of deposits on the banks. The Fed said, we'll take this, and they've been doing that for a while, and they continue, even though banks do keep reserves. I'm not saying they don't have reserves, but the Fed has made it clear. So I said when that happens, we'll know where the balance sheet, where they feel the balance sheet needs to be able to sustain the economy. So let's take a couple, see if we can take a look at a couple things here. I'm just changing screen over. I'll bring you up on there right now. So we'll come over, and I'm just going to put up a a daily chart here of the treasuries, and you can kind of see they have been drifting lower for a little bit from the standpoint of, but look at the algos. So these are the wave tech indicators here, and these is predictive math. So it's telling us that we're probably going to bottom here, which would make sense to me, right at this 4% level. We'll look at a couple of charts real quick. What do we got? About 11 minutes. So I just kind of want to set this up. And this is where the markets are going to be from the standpoint of moving forward. Look at this, right back to 418. It's really going to head back towards this 200-day moving average. So that will be, like I said, all the algos, everything. If you look here at the indicators, they're all looking to higher. Doesn't mean this will change. I'm going to bring something up when we get into some of these numbers that I haven't showed you. Some of you that have been around a long time will remember me with my 5-second chart and with the algos on there. So we'll bring up some of that stuff. It's kind of fun to watch, but it'll show us some of the volatility that we're likely to see here in a few minutes. But the 10-year looks set up at some stage. My plan is to listen to the announcement, then not listen to noise. We'll listen to Powell's statement, and then after that, we'll just be on our own, and we'll keep a watch on the markets a little bit here. So let's go, and so this 10-year is pretty good. I'm just going to flash out, and this will give us a better feeling here and of what's going on. This is the weekly chart that I've got up here, and you can see the 200 is rolling up in here. So we're going to come into the 200 and be support. That's 390. If we went all the way down to here, 385. So we could see what I would call a sympathy rally in the bonds, pushing yields down a little bit. If we get everything that we expect today, and then expectations will grow towards the, for another decline in or drop in December. So that's basically the expectations that I have. And I'm hoping that I can turn on. We're not going to have any visual on there. I used to use YouTube TV. They won't let you stream or overview, and I couldn't get a camera set up to get it. So we'll just go as it is here from the standpoint of listening to the statement, and we'll talk about it. And just like I said, we'll be on our own from that standpoint. And by the way, thanks everybody for coming. I appreciate everything, and I tried to keep my life private, so I appreciate all the comments and on everybody made about the loss I had, and it's very difficult. And she was actually, just to mention that, she was 20 years younger than me, so it was never supposed to happen that way. So anyway, let's go ahead and let's see where we are here. Yeah, it's interesting. They're showing 30-year yield right now, 457. I haven't talked about that, but that whole back end of that curve, not much is done in that 30-year anymore, and it's all been on the 10. That was thanks to Bob Rubin back in the day. So let's let me come back up on screen here, and let's see if you folks. I'm going to put on this. I'm going to turn this on, so I just want to see if we can. We're about 8 minutes out. I'm going to do a test here. So let's see if you guys can hear this broadcast.
If they ended, I don't really see that as a big market moving event. What it will do,
give me a thumbs up or something.
Allay some of the fears in the repo market potentially.
Explain, Bob, Michael. Trevor, we need to do this, folks. It's a course.
So can you folks hear that? Let me know. If so, we'll use that as for the announcement, and I do want to listen to Powell's opening comments, and that will go from there. Okay, cool. Very good. So, like I said, there's a little delay because I think YouTube's about a 20-second delay. So good. So I saw the meters moving, so I just want to hear from you. Okay. So this is going to be an interesting Fed meeting. And the reason why I'm telling you that is that they're going to have to somehow, Powell's going to have to navigate trying to say, oh, we don't have the data. It's going to be interesting. See if there's any Freudian slips in his deal. But they, like I said earlier, they have the data, know that that's the case. And what I'll do is when we do the announcements, I'll put the, I've got a screen up here where we can, this, let me go over to this other screen. And this will, this is the infamous 5-second chart. And we'll let this run. You can see it's showing a rally coming up here. This, if I come all the way out here, this is 6 minutes in the future. So this is interesting. This is a fun chart. I love using this. We get real-time Fibonacci. Everything's updating. So this is, I think right here, we've got the Fibonacci tool on there. We've got the WTR predictive moving averages. So this is showing us the direction, and the red dots are showing us the short-term direction of market movement. So it's kind of interesting to watch because you'll see the algos working in real time versus watching a daily chart or something like that. So where are we at here? About 3.5 minutes. So like I said, I'll keep this up. I may mute them out after that. Maybe go back in if they start talking this. It's interesting. There's one guy that when Mike McKean, call him out by name. You can just look at Powell's face. He does not like this guy at all. Every time the guy asks a question, it's Powell just like is frowning the whole time. So look what's happening here. We're getting a bit of a forecast the next 6 minutes, which will be into the report that we're going to roll down. Everything's changed a little selling coming in here. So we'll see how this sets up as we come into the marker here. I've got about 3.5 minutes to go. So everything's kind of delayed here too. I don't know how long this TV that I have over here is delayed. So we'll see. But you can kind of watch the algos working here. There's some Fibonacci targets down on the bottom side here, which are 69.33 all the way down to 69.31, and you can see all the algos are turning south here right now. So and the market's moving in that direction. I think this is probably the place where you find out where the you can see the indicators work in real time and see their predictive probabilities and the accuracy. So it started forecasting down toward these Fibonacci targets. They're not much. I mean, they're like $2 or $3. It's not a big deal, but it does give you a good feel for some of the predictive capabilities. We had a little island projection up here for higher prices where my cursor is. So we'll just hang out, be patient. Okay, yeah, just looking at some of your comments here. Yeah, I really appreciate it, folks. I try to keep my private life private, but I think everybody understands what's happened to this channel in the last year, and it's really been the last couple years. It goes back to November 2023. So yeah, it's been a tough. It was a tough ride. She was the ultimate warrior, I can tell you that. Okay, so we're getting see how the forecast just firmed up here. All of a sudden we're getting flat. If we go, like I said, all the way out right now, this is 6 minutes. So these are 5-second bars, every one of them. And if you figure out this is predicting where the market's going to go, you can see we already went right back to the 200 period on here. So it looks like a sideways as we come into, let's see here. I'm going to put my cursor. This is right at the 2 o'clock marker. So we're a minute and a half. So I'm going to let's hang out, and while we're watching this chart, let's listen to the last minute or two of what these folks are talking about
what they don't see at the moment.
Which I can put you on screen here.
A slew of questions from everyone, including Mike McKee. So the press
Yeah, Mike McKee's a guy he doesn't like.
30 minutes or longer. He might get into the details on QT if they do announce QT. So I'd be curious to hear what he has to say. And he's probably going to also kind of.
Yeah, the QT stuff is going to be, for me, that's the big announcement that's going to happen. I care more about that. The quarter point, everybody knows that's happening. They even telegraphed it before they went into their so-called dark period. So they've already told us that that's happening, right? So we're just waiting for the official announcement. But the QT, and this is why I want to listen to what Powell says, and I'll go back and listen to some questions before I write the newsletter tonight. But this is going to be pretty key here. Here we go. No?
In front of some of them recently, and they're eager to learn.
I can't decide which show I hate worse, Bloomberg or CNBC. Here we go. We've got a little spike going on in prices here. So chances are the news is already out. It is. And this is the delay that we're listening. So
the most recent data, the only data we have is inflation, and headline and core around 3%, and the Federal Reserve set to cut interest rates to 25 basis points. I understand why, because they're worried about the labor market.
Man, this is delayed terribly. So I needed a better source for sure. Yeah, exactly. No liquidity. I usually have this other screen. So you're seeing the volatility. Yeah, this thing still has still not come up. So what is that, about a minute delay? Yeah, over a minute. So here we go.
A divided Fed cuts their benchmark lending rate by a 0.25 percentage point and says they are going to end QT December 1st.
There we go.
There are two dissents as policymakers reset the target range to 3 3/4 and 4%. No surprise, Stephen Byron dissents in favor of a 50 basis point cut as President Trump wants. And Kansas City Fed President Jeffrey Schmidt dissents on the other side in favor of no move. The Fed's administered rates for interest on reserves and the primary credit rate.
Yeah, I should have went with CNBC on this because at least they read the statement. These guys just didn't read the statement. So we'll take a look at that. Excuse me. So you can see basically we haven't done much. You know, we got a little spike in volatility. Typically, I talk about this when we see this spike. That's usually a trade that I do where I fade the initial move in the direction you fade it, and there's usually a quick scalp. We're getting some upward projections now. You can see some dots coming up here. These are real-time Fibonacci, and like I said, it's a 5-second bar chart. If you want to use this on TradingView, I think you have to have their top value from that standpoint. You have to have their highest level and real-time, obviously. So, but you can see we're getting some fib targets up here. We'll see if we start to get anything. So let's just go ahead and let's come back, and I'll leave this on screen so at least we can watch price movement when I'm talking. So this is why Powell's statement is going to be interesting. There's probably going to be some volatility from the Q&A as well. I think understanding that this what their actions were is all we need at the moment. I hope that the Powell statement, I may take you folks off screen, and I may crank up CNBC. They do a better job of not. Bloomberg has to have their opinion on everything. They have to stamp everything. So there's a case. We just got a little drop in prices here, but really we got a range. Let's take a look at the range. We're looking at 45 down to 30. So we got about a 10 handle range here set up. Let's blow this up just a touch. Let's bring up the indicators. And once again, I'll change from the length of the charts. For right now, we're just staying in short term. You look like as we look out, and once again, going all the way out, everything we're seeing on the screen. This is projections for the next 6 minutes, right? So, and it's very dynamic as far as the algos are going to kick in. But we really didn't get much of a volatility spike. And let's go ahead. Let's change this timing just a little bit, and then we'll move on to some other things I want to talk about before Paul. So here's the 5-minute spike, pretty muted. Talk about everybody already understand what's going on. Let's go to the hour chart, and let's just try to get. So interesting on the hourly, this is now, we went from a 5-second to a 1 hour chart. So the hour chart is showing, we had what I call an island projection, but we are seeing that at least the hourly for right now is going to slope up, probably using this 40-hour as the bottom end of the range, which is putting us, we're pretty close to it right now, but that's going to put us down around 25, 27. We'll look at some other metrics, but the overall, looking down the road, this is into, Thursday and all the way projecting into Friday, that we're going to see more new highs. There's some projections I'll talk about. Let's go ahead and do that while we're here. Let's take a look at the daily. And you can see that on the daily, we just got this monster move up, and we've got these fib targets up here. And this is what I want to show you is 69.80. We could see that fib target 1 hit. Then we got some other fibs up here. We got the 7,100, and to say by year end we're going to get 7,100, that's somewhat of a joke. And I believe that I mentioned this in a newsletter. If we go back to this April low, I believe we're up right at 40%. That's an insane rally, folks. 40%. This is in spite of all the crap that the news media and everything's been throwing at us, to the that the tariffs and the economy is going to crash. Go back a year ago when Trump was elected, the end of the world was happening. And in fact, the world looks better than it ever has within a year, from the standpoint of we'll say a common goal looking forward. Even Europe's coming alive, and that place has been dead forever. It feels, maybe going back to 2011. I mean, it's terrible, back to the European crisis. So, we're just looking at this whole formation of this is pretty phenomenal. Do we get a correction somewhere? We'll go back to this later. I'm going to go back and just talk a little bit more about the interest rates and some of that stuff. I want to go back and take a look at that, because at least for the next 30, 40 minutes, let's focus on that. Maybe we'll take a quick look at the yield curve and a couple other things, because I think that's what's going to drive these markets at the moment. And so I didn't ask you folks before. It looks like quality of the voice, everything's good, because this thing hasn't. Not only has it not been cranked up, I moved all the equipment and everything, which is anybody that owns a Mac knows that that's like something you don't want to do very often, especially if you have a Mac desktop. I have a Mac Mini, so it's just Yeah, it's just kind of crazy. Anyway, but yeah, let's go ahead and let's go over there and take a look at some of these numbers. So this is I think an interesting view. I'm going to go back and just so we can look. This is going back to 22. But since 23, we've been in this range, and we're finally I remember looking back here, the 200. This is a weekly graph of the 10-year. 200 was way behind. We've got some Fibonacci targets that are still live here right now. 371, 330, 314. Don't see that happening, but we could end up coming right into this. This 375 would be, if you're watching that rally, you want to short the bonds at that level. You do not want to mess around with trying to get more bearish or more bullish at that stage. Yields are going to stay pretty much where they are, and they should, just based off of a long-term kind of viewpoint of where, if you look at it, not a long-term, but a historic view. Unless you're Ray Dalio and he thinks a historic view is 400 years ago, I have to put a Ray Dalio jab. He's been Ray Dalio, He was much better when we didn't know what he was thinking, back in the day. Anyway, but everything you see is consolidating right at. This is an inflection point. There's no doubt. This upward slope. Let me bring up all the indicators. What's interesting is I think I can do this. Yeah. So this is just the ppm 200. So this is what's in. So for those of you who are maybe new here or just a quick refresher case, what these indicators do is they track the internal movements of moving average, and there's a probability map and tells you when. Everybody looks at moving averages. I don't use the 250, the typical retail view or whatever the media has built out there to make it easy for everybody. But I look at the internals, and the first and second derivatives tell us whether there's going to be a change of direction. Now, this is showing that there's going to be further a deceleration of the angle of attack, which says that the 200-day is vulnerable to a movement down. And this is because it's weekly. I'm looking here. This is out into August of next year, 2026. So this is a huge decel. Now, something could happen. It starts to flatten out in this prediction, but this is a weekly algorithm is suggesting we're going to see quite a bit of weakness. So if we come back here, at the moment, there's still an upward slope. So that's one of the hard things you have to be careful when doing analysis with these indicators, is even though, I'm bringing this back up, even though it's declining, what's happening, it's losing its internal probabilities, but we're all the way at, even if I come here, it's not until, I'm just trying to get to a number here, bear with me. Yeah, we don't even get negative on that. So that upward slope is still going to have probabilities that we're going to hold above there. It looks like this is a collapse coming, but all it's telling you is that there's a lower probability of holding. But right now it's at 0.27, so it's at about 65-70% probability that the market's going to stay above the 200. So once you learn how to use these indicators, you have the confidence. So here's the thing that we've all went through, and this was 1984 when we figured out this math, and what it was that we could see that the probabilities that the moving average would hold, and it would hold. We spent a lot of time trying to figure out where is it going to break down where we can't count on it. So if you can count on a 60-70% probability that it's going to stay above the moving average, so you can trade against that number. And that's what we learned to do. You have to understand there were hardly computers in 1984 compared to today, right? But we had we were able to build these indicators in a platform called CompuTrack. You can Google that one. There's a Wikipedia, I think, on it. But it was one of the first technical programs that gave you the ability which to build your own indicators, and that's where that history goes 40 years. But the point is that these probabilities work pretty good. It gives you some confidence. You still need to use trade setups and stops and all those kind of things, but it gives you the confidence that those things are likely to hold. And when you have that, especially when you get into this 90, some of these probabilities are real high, and you get into those moving averages, and you've got, a 90% probability that it's to hold, you can, back up the truck at that point. But back to the analysis side, the Treasury should hold above that line, and right now that's 384. So that would be like if it hit that, you would want to back up the truck and sell the bonds, go short the Treasury bonds at that point in time. So. Yeah, let's see here. Let's go over and take a quick look at the equity markets here. Just see, really not. We're right at 31. We're not moving around at all. So we'll continue along this line here. So let me do the yield curve. If I could spell, I can't see. There's a site I usually use here. It's this guy, U.S. Yield Curve. They put all kinds of ads on here, but we can do some analysis here very quickly. And one of the things that we can do is we can shift this back. We can go back. Let's go all the way back to 23. We'll just grab a random number. Great. I did the wrong thing. But hang on one second here. I'm rusty on this old tool I used a lot. Here we go. So I get back to here. I want to do this is what I wanted to do. I want to compare that period going back to mid 23 real quick. Okay. So this gives us the red line is going back to 23, so we were elevated as yields were coming down. You can see where we've been, and I've been talking forever about this particular part of the curve, and you may remember, some of you have been around, that I was talking about the yield curve going across the 4% range. We're still there but this is what I'm going to draw. Hopefully, I thought I brought up something here. Uh-oh, I don't see it. There it is. Sorry, it's floating. I've got 3 monitors here, and it's floating around on me. All right, so I want to draw in what these things are doing here. So this is my goal, to get the yields. So we're going to go from 4 to 475, and I want to see them. This is 350, and this is the steepening yield curve. What I want to see is at least 3 and possibly 275 on the front end, and then the back end of the curve stay up around 390 to 410, fluctuating back in that range. And what that will do is make a very healthy environment for lending, doing a lot of different things. And you could even slide that spectrum can move around, but as long as we have that at least 0.75 plus in the yield curve, that's gonna bring in some really interesting dynamics in the economy, especially as we look forward to like 2023 or 2026, 27, all of these capital investments that are planned to come to the U.S. Trump is right. This is the hottest country in the world. Everybody wants to be participating here. So it's going to get very interesting. And hopefully Elon gets the Optimus robots able to do work because we don't have a lot of trained labor out there to facilitate. This is going to be the interesting part. I think on the backside, immigration will become back into play, but hopefully vetted and people that have skills to do these jobs and things that are going to come up in the future. I think the robots we won't get into a robot talk, but I think they're going to be incredibly important from that standpoint. So let's just take all this off. Yeah, so we're just flashback. We're at 34.35 right now. So market's pretty stable, waiting for Powell to come on. Where we at here from that standpoint? We're like 10 minutes away. So we'll continue to talk a little bit about this. And I think one of the things that I've been trying to allude to on, as far as what configuration is going on, is that we should continue to see a positive involvement. I'm going to come back on full screen for just a minute. So I thought, hang on one second. You have to, I have grown a love-hate for my Mac. I was on PC for 40 years and plus, and went to the Mac, and now I'm so deep in I can't get out. But anyway, I think one of the things the themes that I'm looking forward to writing the annual report, and I'll do that in December. Hopefully have it out pretty close to year end. That's my plan anyway. And the whole AI bubble thing, I don't think that's very likely, not at the moment. You're looking at way too much money flowing that way yet to be talking about a bubble, and all of a sudden everything's going to stop. There's a movement on this planet that is going to be tough to talk about and dispute, just from the standpoint of what just a pure amount of capital flowing into AI and data centers, and that's going to be a thing. I mean, I've talked about this before. Let's see if I have an image up. Let me see if I can get one up. I'm looking around my screens to see if I have one. I don't seem to, so I'm going to bring one up. And I'll bring that back on screen here. There's definitely something going on here, folks. Bear with me. What I hate is when something. Okay. Let's see if this is working again. Nope. Yeah. Okay. Some things are breaking. So typical live stream. Where are we at on time here? 23. So we'll get to Paul here in a minute. I have to do this manually, so this is very frustrating. I have a Stream Deck that is decided not to work. Okay, so I brought up this real quick, and one of the things I brought up is utilities, and utilities is going to be a play for a while because energy. This index that we have here has been long since over a year ago on March 4th, and it continues to move forward here. And if I come back into the research area, we'll get some metrics on this, and you see that right now it's 416 days. Those are trading days have been long, so a better part of 2 years. And it's the numbers aren't that big, but it's just steady. If we look at the index, it just continues to. This is the VPM index. Let me bring that up here. We'll see if I can get this up here properly. So this is what the utility index, we've been long since here for a couple of years, and the trends that are going on here, if I blow this up, you can see it's just vertical here from the standpoint. It's been choppy. This was the April, and now here we are just continuing to move up. And I can't, at the moment, I can't get to a longer history at the moment. I can, but it's going to be too disruptive to do that, especially since we're waiting about 4.5 minutes away. But I just kind of wanted to cover all this stuff. This is, we'll go into more detail. We'll listen to Powell's statement. We'll watch the market action again, and then ultimately, my plan is, if your folks are hanging out, that we'll get we'll probably go at least 2 hours. Okay, so I haven't been on for a while. So anyway, let's go ahead and kind of pivot back to the live markets. We'll look at I'm going to put this from weekly back to a 5 minute. This is Treasuries, 5 minute, 10-year. And let's just put this up on the screen. So Treasuries, here we go. We're already up from that 399 to 403. And this has been my argument, is that the back in the curve is just going to stay stable. It didn't drop by, anything. Actually, it's went up. It traded down into this event, and now, it's the old buy the rumor, sell the facts. So when you get the news, otherwise buy what everybody's talking about and play along with it. When that actually comes up, then you can take the other side. But this 5 minute chart again, so you can just see we've moved up from roughly 4 to 402. Is that right? 403. So we're moving, and Treasuries, that's a pretty decent move. I know it's 5 minute chart. If we go back to daily real quick, and then we're going to get focused in on setting up for Powell here. But yes, you can see here daily, like I said, everything's being forecasted higher in yields on the back end, at least for the next coming into year end is how it looks at the moment, subject to change. And people like to take things I say and other analysts and other people out there, and like we said something on October 29th, so that is forever. I was wrong because it went the other way. I don't get to change my mind, but I do. That's the beauty of trading, right? So everything's based on probabilities. All of these algos, everything I do, all the math I've done in the markets basically since 1983 is when we started getting. I had a VisiCalc. In 1980, I had VisiCalc that was on my Apple II with 48K of memory, crunching numbers, doing stuff. It was the first electronic spreadsheet. If it wasn't, they had a word processor and they had the VisiCalc. Those are the only two business applications that were on the Apple II at the time. And if it wasn't for those two, very possibly we wouldn't even know Apple's name today. So let's go ahead, let's set this up and go to the 5-minute treasury. Let's get back over here. We've got go from daily. Let's go back to my 5-second chart. And we'll watch the volatility. We're getting a little bit of a bid, but you can see, so we're getting set up. Where are we at here? 29.36. So I'm going to kind of leave this up on the chart. I'm going to bring in the background noise to, but here we go. So we got Powell in the room at the not in the room, but so it's about a minute late. Like I said, I was gonna switch that over. I'm going to attempt something here, folks. Bear with me. I'm trying to restart this the Stream Deck, so bear with me. Yeah, not going to cooperate. Oh well, I tried. Okay. Here comes Powell. He's coming in the room.
0.2%. The FOMC divided, voting to cut interest rates by 25 basis points. Is the chairman of the Federal Reserve.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in equipment activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low. and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year, as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem.
He always says that, even though there's no evidence.
In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in
Wish I could pause this right now.
our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to
Just
take
got a
another
little-
step toward a more
A little
neutral
hit
policy
in the
stance.
market. Let me put the...
With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
He says that, and
At
it
today's
is.
meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions.
That's what I was talking about earlier.
That we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury
So that's a little
securities.
QE going.
This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
3 times he said
I
that.
look forward to your questions.
Okay. Yeah, so market sold off a little bit. Basically what I was telling you earlier, and I had told you this like a year ago, this is when the runoff started, but he said something, he's going to let the agencies, so that's they're no longer going to sell treasuries, okay? And so therefore, but they are going to continue to sell or let the runoff happen on the agencies. So, and then they're going to reinvest that into treasuries. So you could maybe call that a little QE. Markets are still under a little pressure here. We're down 31 handles right now, and we're getting a little lower fibs. This is a 5-second chart we have up here right now. Let me move it over so we can. So the algos are trying to stabilize. Let's look at a couple lengths of charts here, and then we'll talk about what I think is going on there. And then shortly after this, look, we're still getting some big spike down. That one of the things that when I see this is kind of what I call a flush. When you get this, and usually markets will stabilize and start to come back. I oftentimes, if I'm day trading, if I see the flush, I'm taking the other side of this. It's not quite done yet. This, like I said, a 5-second chart. But when you get this little flush, I'm looking at some other charts above, which you cannot see these charts right now. I have my PC I have 4 monitors here. So the top level is my PC. Bottom, I have 3 monitors on the Mac, but I'm looking at TradeStation here. Order book's pretty much blowing up right now, and we're looking at some pretty good volatility. So it's looking like we're getting crossovers on the WaveTech webs, and that's suggesting we're trying to stabilize right in here. We're 87, 86, so we finally got a decent move out of here. And low of the day 84, we just printed new lows. That was new low print that we're watching on the screen right at the moment. So yeah, finally some volatility. So let's flop around. I want to go to the 1 hour chart, which is where we'll start to see the so I'm just trying to get this thing to scale properly. Bear with me just a minute. So this is the 1 hour. What's going to happen, you can see the red dots. I didn't bring this up earlier, but it was projecting down to about where we are now. So potentially trying to stabilize here. We're finally getting what we'll get is what I call the bubble on this, and then this will have to consolidate for several hours once we find the extreme lows before we'll see a directional movement again. So this is enough probably to disrupt things as we come into Thursday. We'll see how the market flows. We'll what time is it? Yeah, we'll hang around to the close. Okay, so that'll be another hour from here. We'll ride all the way into the close. So yeah, so we've got everything that we need right now. I hate not being able to change my screens very so let me just come up and discuss here. Yeah, one of the things I just want to talk about is that basically everything that was expected just happened. I think I always listen to how many times that their dual mandate that they mentioned, and he did gaslight us pretty good. We don't have data. I do want to mention that, and I mentioned in the newsletter last night, is that ADP is stepping up. They're going to start weekly numbers, just like we get the claims numbers. They're going to start weekly employment numbers, and I would love to see most of the, not necessarily shut down, but a lot of this data that we've been depending on my entire career from the BLS and all the different agencies. It's always been dirty data. It's never been good. And I think if nothing else, on the government shutdown right now, it's being revealed that this data is not very valuable. I mean, you can see how the market's been trading with the government closed. I want to come up and talk about a couple things, and that's why I came back on screen. Is the government shutdown has some potential to have some teeth in it as we go forward. I think the original or the longest was, and during Trump again, Democrats decided to keep things shut down last time, I believe, and this time, obviously. But we're going to start to affect not just the SNAP payments and those things. That's not good. I told the story in one of the newsletters last night that it's a quick story that my mom told me from. She was a Depression baby. She was born in 26, right before the Depression. But she told me about something that happened around 1932 in the height of the Depression, as some guy showed up at the front door. My grandparents and my aunt, they had two girls, my mom and my aunt, and this guy shows up with a shotgun, and he says he's going to kill everybody and take the food. And my grandfather, as the story goes, said, "Sir, we have food, and we're glad to feed you. You know, my wife will make some food." And they sat down and the guy backed off. They sat down and ate the table. My mom was telling me how she thought they were going to die. And this guy had this big red handlebar mustache. This is, 1932. And after, she thought he was going to kill them all. And then afterwards they had, after he ate, my mom said, "He was the nicest man I ever met." He was going from threatening. My point of telling that story is when people get hungry, they do crazy stuff. So the SNAP thing is potentially very big, and it's interesting when you look at life and you can see what people are willing to do to get advantage or power, and this is probably listen, hate Trump, love him, whatever, don't care. But if nothing else, he's opened Pandora's box, and everything that inefficiencies, fraud, everything is being exposed right now on what the power structure of the government cares about. And it goes all the way back to ADP starting to put out metrics. I believe there's other private folks that can aggregate public data, maybe solicit, I hate surveys, but maybe do surveys and just start to replace this agency data. I would love to see that. It's a long story to go that route, but I would rather see something like that, more something that we could have some real scrutiny over, because these government agencies, there's just too much crud in there. And I mean, Musk and Doge and all this stuff has been, it's very exposed, and I've been arguing whether it's blockchain or something else that we should have literally real-time metrics like meters on the economy, everything that is transferring around through the system, cash flows, everything. That stuff just should be real-time, and ultimately there's no Fed. There's like an algorithm that just adjusts all the balances and tries to keep stability in the markets. Instead, we got the Fed, a bunch of guys smoking cigars in a room, making decisions, random decisions about where things should be. And any of you been seen anything run by committee? It doesn't work very well. And but those days are over. I mean, the Fed's over 100 years old. It's just time to abolish most of everything is my argument. So that's probably my rant for the day. But this is just more obvious type situation from that standpoint. I'll just put the screen. Basically, it's trying to stabilize. What's the close on this? Real quick. Yeah, I'm looking at right now. There's probably about 10 minutes and 11 minutes before the close on the hourly. We'll get an update on that, so we'll go back. So let's do some from this point right now. 11. We got about an hour. I said I'll hang out. So if you folks are willing to hang out, I'm going to kind of go through the things that I normally go through and just look at the analysis of the market. So stick with probably weekly, maybe bring up some monthly charts to talk about that. We'll do the typical routine that I usually do on the channel. And then after we get that done, we'll broaden out, and at the end of, we'll keep an eye on what the market's doing. If you guys would be my eyeballs, if anything, big movements up or down start to happen, if you'd alert me on the timeline, that would be great. Then I'll go and take a look at it. But I want to go and actually look at doing some analysis on some of these charts. Look at, like I said, more so than the short term, just getting into weekly, monthly, start to get into some of the broader trends. We're coming into the last couple of, months of the market for the year. We'll talk a little bit about the database as well, the intermediate database. So I just want to kind of go almost like we're just starting the normal stream to go from there. Yeah, hang on. I have to do this manually, so I apologize. All right, so let's go ahead and flip over to a weekly chart on the S&P, and I'll do weekly, monthly. I'm not going to go out further than that. But this is somewhat interesting, and I'll go through the things that I as efficiently as I can. But look at this, the projected angle of attack. This is out July 26 here on the weekly. But you can see all the algos at the moment are still projecting out in this upward projection, and we're looking here 73. This is the moving average, so that means if we follow this line, and I'll bring up the indicators, everything's stable. And this is something that it's those of you I see names that I know have been around for multiple years on my streams that I do. And let's just bring something up, because this is something, especially for the people that have the indicators. If you don't, you can check out kendallreport.com/indicators, and you might want to put indicators 24. You can do that. But the bottom line is that this angle, this is something where I call the a trend maintenance mode, when you're just looking at trends, right? So you can look at moving averages. If you were hanging around earlier, one of the techniques that are here is that when you have a certain range of momentum that's coming off of these indicators, and it tells you what the probabilities are of a continuing trend. So this is something that way back, for those of you who've been around, this is, I'm just drawing in these red lines. I'll take them off here in a second, but all of these are in, and there's still acceleration to happen on the longer term averages. But this is, and probably one of the best indicators ever is this 200, because the 200 is just telling you the underlying, I'll draw here, is this upward angle of attack. So the whole basis of what I'm showing you here is when these indicators down below, let me pull this off, when these ramp up and you get, this is a pretty extreme here, it comes into and it declines and then normalizes. And this is what I call trend maintenance mode. And this is, when you look at this angle here, all it's telling you is that this angle I just drew on the 10, this is weekly, 10-week moving average, is going to continue up, for the next 6 months. Okay, that's minimum. This over here, this let me change color so they'll be easier to. Then the this is your 40 period moving average, and that's this one here. So it's showing that it is likely to accelerate here as we come into early 26 and then fall in toward maintenance mode here. So it tells you that this 40 period moving average, unfortunately I'll have to unfreeze the screen, I'll get you some values, but this configuration is going to continue higher. So, and remember this, that I have to close this out to be able to change, but remember that when you see this type of configuration, these are intermediate trends. They don't change very often. There's not abrupt changes typically. You can see we got down to extreme on the April 2nd lows, and like I said earlier, we were up almost 40%. And I go back to what I was talking about in the newsletter then, is I wasn't on YouTube occasionally, but this whole thing, I thought we'd go back up and go flat again, and that we would see some softness in Q3 and 4. You folks heard me saying this over and over. What was happening, we'll go to the database in a second here so I can show you, but what was happening is the database looked like it was going to roll over. And I mentioned this as well. This is the third year of double-digit returns. I mean, we've just watched, go back to, remember everybody told us that 23 was going to be a bad year. I told you it was going to be probably double-digit returns based on the database. We came into 24, same thing. I said, we're going to extend this. I thought we'd see some softness mid-year, but it was a similar analysis going back in 24, and then we got rotation back in the database, and it just continues to rotate. And even though you're going to hear people tell you it's 7 stocks, well, I'm one of the few guys that monitor. Let's just put that up on the screen here real quick. But when I look at this, we monitor, let me blow it up so it's easier to see, 14,378 stocks, and all these database metrics are based on those 14,000, not on 7 stocks, not on an S&P index or some manipulated index that is cap weighted and all that. We're looking at the broad picture. So these are much different viewpoints that come out of following the database than you get in just following an index that 7, and really it's about 30 stocks drive the entire index, and we all know the Mag 7, all the stuff. But the realities are that's not true. Right now, 72% of the symbols on intermediate basis, 10,410 stocks, are in uptrends. It's not 7 stocks. I saw some, no efficient any of the millennials watching me. I saw the stupidest probably post on Twitter I've seen in years, and some kid talking about there's these 7 companies, our whole economy is based on them trading, with OpenAI buying chips from NVIDIA. Somehow that's the entire economy, and it's not, right? These people are doing business with each other because their businesses need things that each of them do, including when I was talking about utilities, energy, power. Right now, you can't get enough energy and power on this planet, okay? It's starving for energy. So anyway, but 72%, 7 out of 10 stocks, any symbols in this database are long. And right now we've got 8 of the sectors, the conglomerates, consumer cyclical, consumer non-cyclical, and transportation are not in play in the moment inside of our database and what it's telling you. So what's happening here is there is a selective economy, and maybe if you're in some of these areas, you see people, all the people, I'm going to make an assumption, most of the people that you see post how the economy's bad means their economy's bad, and they're that's out of favor, or their jobs have been affected. So that therefore, what's the old saying? If your neighbor loses his job, it's a recession. If you lose your job, it's a depression, right? And that mentality, especially with the open world we live in with X and other elements, that those things are going to be perceived in those. The economy's not good, and I just want to say I'm sorry you lost your job, right? So, but anyway, but these elements, when you're looking at elements like this that are, that affect all of this stuff, I'm talking long term, generally speaking, with the capital investments that have been promised to this country, 26, 27, we're talking trillions of dollars of investments. And, Trump's tour in Asia right now has been very fruitful as well. You look at the scene, that we were throwing nuclear bombs on Japan, not quite 100 years ago, but 80 years ago, and now they're giving us gifts and everything else. So the world changes with time. But this maintenance thing, I went a little rant on this, but this maintenance thing is real. And this goes back to those of you that were hanging around in 2020, is that, this was the projection. We got into that initial ramp up into July of 2020, and everybody was telling me how the markets were going to collapse and that we were going to go down to new lows, and we were all going to be, it was funny, I literally I'm going to go 6 weeks ago, I had an entire chest freezer full of 2020 food. I finally found an opportunity. I emptied that thing into a garbage can. It weighed like 200 pounds. It was kind of funny. I was worried that the garbage the garbage guy wasn't going to be able to lift the can. It was going to break the arm or something. But so back when even then, the projections, the database, the algos. At that time, we didn't have the autoregression math for the projections, but everything was in this maintenance mode. So all we could see is where the line is solid on these indicators is where the data we know, and then the dotted lines and the faded lines are projections of what this thing is going to do. So, and that's also influencing the projections on the dots up here, which are taking that maintenance mode and showing that angle of attack continuing all the way into mid next year. So this is a big deal. All right, so I'll set this up because a lot of this stuff is common as far. I have to go to SPX, so I'm going off the futures into cash here, and just so we can get some of the projections. Now this is the monthly projections. not the same clean pattern, but if I'm looking here, this, where the projections are suggesting we're going, is to a 0.69, which tells you that we're going to stay well above. Let's see where this number gets us to. Yeah, this is almost getting to 7,800 on the S&P, and that's for 26. If we go off the monthly projections, there's a whole lot to go on these markets. And by the way, these things stabilized down at that low. We bounced a bit on the real time stuff. Where we at here? We're back at 80, 68, 69. I'm sorry, we're 69.02. We're back above that handle. So we traded down and we're back up. I forgot I'm on the cash, but we are seeing some peak values coming in at the end of the year, and then, but all of this, like I was trying to tell you, if you have these indicators, when you see this, it does mean that we could fade back to the 10-period moving average, but it's not really projecting downside or big downside trends to form at this stage. And like I said, all these capital investments, everything that we've been listening to for the last 6-8 months since April 2nd are coming true. And tomorrow will be interesting because we're waiting for the China agreement, right? So we'll see what comes out of all this. All right, let's move on. Let's go to NASDAQ. So I'll go top down with NASDAQ. I'll just leave us on the monthly here. I don't have the predictive stuff, but this is something I do want to bring up here, just looking at this. If I go back to April of 23, this was out of the WaveTech indicator suite, and it was projecting Fibonacci targets. And in 23, the price of the market at the time, hang on, I got to move some stuff around. So the price at the time was, let me just come up for 1 second here, was 13,325. The projections were for 20,623.24, 500, and 26,889. So going all the way back to April of 23, these projections were valid. We kind of consolidated around this first target. We got the April 2nd low, and then the moon shot up. Already satisfied fib target 2. Fib target 3 right now is at 26,889. So this is the monthly projections. We're trading at pretty much at the RTX level. Let me bring that up for you. So over on the far right, you cannot see this. Hang on a second. I didn't realize you couldn't see these numbers on this setup. All right, now you can see them. So over on this far side here, you can see here's a 26,357 is the EXT number for this month. 26,326 is that number. So we're looking at, bear with me a second, 26,357, so far 26,326. So we're close to the RXT level on the monthly, and this is, so we're as far as this goes, we're good, and if we finish up, the algorithms are likely, in the market grid is likely to continue to project much higher prices above this Fibonacci level. So just know that that's going. Now we're on monthly NASDAQ, so we're going to go back to weekly here. So we did top down here. Same thing as we were seeing in the S&P. Let me bring up the indicators. This trend maintenance mode on the intermediate. And intermediate trends, oftentimes, when you're looking at intermediate trends, the intermediate trend is the dominant trend. So if you look at the monthly as more of a secular trend, the intermediate as the weekly as the intermediate, and then the daily as more of a short term. So the realities of the markets are, once again, we're not going to be talking, I think, about anything super negative until July or so. So the amount of wealth, the amount of expansion of the total capital values are absolutely crazy. And I will make a prediction that is the opposite of Ray Dalio and talking about, how the 100-year debt cycle and everything is going to crush the U.S. I believe, and I was trying to find it, I did a model for the GDP. I want to update that model and throw some new elements in there and add, there's more capital investments and things. If you recall, those of you that get the Kendall Report letter, which is kendallreport.substack.com, if you sign up for that. But I've got it set. I think you can go back to almost a year. Once you get signed up, you can find it. But anything that says GDP in the headline should have this model that I built, and and you can actually copy the link and keep it. But you can change the metrics on what the GDP is going to be, the tariffs. You can change all kinds of stuff. Which is interesting, is it's forecasting almost two things: a guaranteed 3.1 plus GDP number, which we're already running at. I think there's a potential for a 5 and 6 handle on GDP, probably in 27. Could happen sooner. And when that stuff happens, you're going to see expansion, and maybe there's on the S&P there's a 10,000 S&P number. I remember joking about a 5,000 number back in the pandemic, and we were well above that. So these markets what's going on here right now, folks, is a substantial move in the markets and the golden age, as Trump calls it, is upon us, and you're not going to do very well fighting that. There will be times where you'll be able to short and trade on the negative side, but if you look at the longer term trends, and especially look at the political backdrop that we have, there's a possibility, I would call, going in through 26 in the midterms and going into 28, that the power that you see on the side of the aisle will remain that way unless something drastic happens. So it's very possible these policies and other things are going to be continuing for another 7 years. And I think that's what we're looking at. Since I said that, I'm going to bring something up. I have to go here. So I'm going to bring up I've got to go to the quarterly S&P because it's one that there's the best data on. I said I wasn't going to do this, but I'm doing it. So this chart here is the quarterly chart. Let me get off screen here. This is the quarterly chart, and we have 7,100. Here's that 71 number I keep throwing around, and then the next level on the quarter is 77. And if you look at this projection carries us all the way into 29, like over 3 years ago. Thanks, Brad. Appreciate the super chat. Yeah, I mean, this is just really, this is big, folks. none of us have ever seen anything like this. Especially if you look, over here at the low value here. I'm just trying to get right. So where I've got that cursor right now on the X, that's where Trump was first into office in January of 2016, and I remember seeing like an old Oprah interview. He said he didn't think he'd ever run for president. He said, but if I did, he goes, I know the country would make a ton of money, and that's pretty much what happened. Of course, we had that 2020 blip, which was the pandemic, that joke of that was played on us, talking about gaslighting, and then here we are. It's not even showing that this thing wants to even on the algorithms, and they will update. Like I was showing you on the 5-second chart, they just update all the time. As more real data comes in, the algorithms are going to pick up. But right now, the fib targets, 7,800's coming up, 71's probably our next step. Maybe we'll get some hesitancy, but like I said, you got trillions, maybe 10 trillion plus of new capital investments coming in the United States in the next couple of years, and at least starting. So construction is going to, so there's a couple phases here. So let me just come back up, and then I'll set us up for the rest of the stream. But there's a couple phases here that we need to consider, is the construction and building of the infrastructure, which that is the phase where we are right now. So all of these capital investments coming in, data centers being built. Meanwhile, technology in the background is growing and changing and demanding more, whether it's AI or other things. And so what I'm telling you is we are in the building phase, so construction and related things are going to happen. This is probably going to be part of the theme of the annual outlook for 2026. But once you start to get these things functioning, the data centers and other, whether it's car manufacturing, whatever it is, right? As you get into that next phase, then you get into you get the spending phase, and then you're going to get the income phase. And anybody, sorry, Mr. Dalio, but anyone that's talking about the decline of America and the world and all that crud, looking in a rearview mirror because something happened in, I don't know, in 1400 or some historical event, and that we're not living 1,000 years ago. We're living today, and what's happening on the planet with humanity, robotics, automation, everything is so big. That's why these charts look like this, going all the way into 2033. This is big stuff that's happening, and I think mini nuclear. I'll throw a couple ideas out there, like the little semi-styled truck nuclear. I think energy can be expanded quite easily. The area I live in, Arizona, is up in the mountains, literally in what they call the Quad Cities. There's about maybe 125,000 people up here, so it's minimal. You could pull one of these trucks up into one of the switching stations for all the electricity where the wires are running, and just plug in one of these trucks and run this whole area for next to nothing. Arizona, although is I believe is the greenest state there is, because we're hydro and nuclear powered. There's a couple small little production plants that are kind of off that grid, but they're in low population areas. But Phoenix is run by nuclear, and some of the hydro they pump down from Hoover Dam, and there's a saltwater project. So we're all hydro, and so when you're driving a Tesla in Scottsdale, Arizona, you're one of the greenest people on the planet. If you're into the climate thing, right? So you're running on the best of the best, and so but that's why this stuff looks like this, folks. We really are in some kind of, call it whatever you want, this new era as AI, everything's expanding. The one thing that is not expanding, and I'm going to just say it for right now, but is demographics. The millennials are the largest demographic group ever to exist on the planet, not just here in the U.S., on the planet, followed by the smallest. The Zs and the Alphas is a cliff. And that's why Musk is always yelling. You got Bill Gates talking about population. And by the way, speaking of Bill Gates, I saw he's pivoted. He's not worried about the climate anymore. Anyway, it's pretty funny what happens. But but all this, the population growth is going to stop. So we're going to need the robotics to fill the gap for the people that don't exist. And even if you shuffle the planet around, India's the only population that is growing right now, to the best of my limited research that I've done on it, but I believe India is still expanding. China's going to lose 400 million people in the next 30 or 40 years, and they haven't even been honest, I don't think, about their current population. I have an adopted Chinese daughter, so I adopted back in 2003. So I've seen firsthand. I spent a month in China, better part of a month in China in 2003, and it was a very revealing thing for me. But I digress back to the population, demographics. Technology is going to have to be able to automate, whether it's robotics and other things, to overcome this. Now, this is a 20-year out issue, okay? It's not today. So there is a 20 to 30-year window that is going to be able to rotate out as the millennials get into where I'm at. In late 60s, I'm 73. So these things are all going to happen in the population rotation. So those gaps need to be filled. And the good news, we got a lot of smart people on the planet. They see it, and what do they see? The opportunity in these areas. So there's a lot of things going to change. You see a lot of folks, actually, folks meaning the BlackRocks, the big investment firms, starting to get away to do invest in private businesses. Some of the things going on at Robinhood, and they're trying to tokenize companies. There's a whole, folks, the world's is not only going to change, has changed. And it's amazing to me that I see people in my boomer phase, where I'm at in this planet, talking about these things. And it's fascinating to me that they're not talking about the news media is to a point, but it's more the bubble talk. I mean, it's just what's going to sell clicks, right? So very few people. This is somewhat boring what I'm talking about in a way, just because these longer term trends are going. So another rant for the day. Yeah, somebody's saying, yes, Floyd's Garage. Yeah. I said, I'll just tell you my comment when I left China in 2003. I said, if they figure out how to digitize this place, otherwise, they had wads of cash. I mean, like big wads of cash, and they could count these yuan so fast. It was crazy. And I thought, if they get out of the cash mode and get to a digitized world, which they went 100%, right? So we know all of those things. Won't touch on that. But once that happened, then you saw this massive growth, and now they're more of a mature. That part of the cycle has matured, but also this demographic thing has already started. I just mentioned I have a Chinese daughter, adopted daughter, and that's part of it. There's not enough women over there to procreate. It's, you know, they've shipped them all out. Not all, but a lot of them. And it's, yeah, so they've got their issues. Anyway, so let's do this for the rest of the show. What we got? Almost 35 minutes. You folks, you know, tell me what you want me to talk about. We'll kind of close the last half hour out here talking about stuff. Markets have rallied back from being down 30 to down 13. Let me go on. It's really, yeah, so let's just scale this all the way back. And let's get into, let's take a look at that hourly chart here now. So this is what I was trying to tell you earlier, is we got this big spike down. This is interesting, folks. I gotta blow this up and show you. So this is a value, like probably one of the best things that I developed, and I'm trying to remember when we developed this algorithm was in, I want to say it's like 85, 86 when this came into play. But what I'm blowing up for you, these orange lines are the market grid, and we did manage to close just under the market grid, but look how we spiked down, and there's only about 12% of the time we close outside of those orange lines. So those of you that have the indicator suite, and this market grid is pretty good. And I'm going to just see what I've got here. Bear with me a second. I'm going to bring something on screen, and then I'll look at the timeline, see what you folks are talking about. This is yeah. Let me just bring this over on screen for you. All right, I'm going to zoom in here just a little bit. So what I've got up here, this is the this was the data sheet, and one of the things that we do in the data sheet is we give you some probabilities for this thing to levels are going to be hit, and this gives you a pretty good idea of where the market's going to flow. So I put these out in the newsletter every night, and let me just get to the S&P here. This is actually the data sheet that is run. Yeah, so this was for the futures, and we're going to give you like some targets and what the probabilities are for the targets on the market grid. Soon, like I said, this is going to be something that you're going to be able to use yourself, so you'll be able to run it on any market. Yeah, just looking at a couple comments here real quick. I see Christoph said, thought there was only around 5,000 stocks. Yeah, that's ETFs, mutual funds, indexes, everything. There's actually over 7,000 stocks, I believe, right now. I just happened to notice that comment. So that encompasses everything. I mean, there's, I think, like 14,000 mutual funds. Yeah, so there's indexes, ETF. That's what's in our database. So there's baskets of stocks being looked at, all that kind of stuff. But you can see here the hourly. What I was showing you is we have bounced back, and look, it's now forecasting back into the pattern again. So great opportunity on that. Was pretty much the flush I was talking about. I didn't do it today, but I was thinking about I'll get set up a little better. I mean, we're all the way back up to 69.10 right now, and I'm just looking at the futures printed 82 low. So there's been a 30 handle rally. So been a nice day to be trading, taking that flush on the other side of that flush. Let me see what else you folks are talking about here. Okay, so so there's a whole suite. There's actually 19 indicators. Somebody's talking about. Let me just see what the name is. Goloth, I think, is a name. Yeah, so these things are available right now. If there's no trial period, you buy them, you own them, but they're one time. There's no. We used to offer subscription, rent to buy, stuff like that. It was just way too many hassles with customer support and people not understanding what they were buying. So so you can get them. They're $447. KendallReport.com/indicators, and if that doesn't come up, you can put indicators 24. I think that'll work. But there's, and like I said, part of the channel pivot that I'm going to be doing is I'm going to be doing some education on some of these aspects of things. But yeah, so this hourly is already coming back in. It's projected. We've got some little negative downtrends that developed within the hourly. It's going to take a couple of days to stabilize once Powell's out of everybody's head, and we're moving on. Let's see what happened. I didn't want to go here. I wanted to go here. Here is where I wanted. So this is the 5 minute on the treasuries, and I told you, even though they just lowered the front end of the curve, what happened to the treasuries? They sold off. We're up to 406. They're printing at the high of the day on yields. So this is even though the Fed said they're not selling these securities anymore, then that didn't give any relief to the back end. That's been somewhat of the pressure that we've seen over the last year or two. Is that selling of that long end of the curve? So. Yeah, let's do it. So MSTR. This is even, in my opinion, the biggest Ponzi scheme ever, or the most brilliant thing. So we'll tie this together, and we'll go through Bitcoin as well. This is 5 minutes, so let's get to a little more. Let's look at daily. I think I'm sensing some things on this, but I think this is down like 35% or something from the highs. I could be wrong there. But this has not been a good trade, and it's interesting. I want to show you something here, and I mentioned earlier, just from the indicator standpoint, is that over here, I put my cursor right where my cursor is here. So on this that little break off of the highs here is where if you look at the very, very bottom indicator down here, what you'll see is this was broke through first, second derivative, signaling a downtrend that we're going to challenge the 200-day. We did that in August, and then we've kind of hovered below it, back above it. Now we're seeing further declines, and now that indicator is starting to stabilize. So we're probably in the next 6-8 weeks closer to a bottom here, and the top was signaled pretty accurately just using the 200-day. Yeah, I see. I'm not sure how to pronounce your names, but it's talking about the stock market also seems to be untethered from the economy. I think I don't think it is. I think it depends on what you mean by the economy. What I look at when I'm looking at individual stocks is, especially when you've got these weighted indexes. That's why I talked about the. I'm going to show you something else because that's a really good question to ask. But a lot of these environments, the AI and different segments of the economy are doing better. There's certain ones that there is some rotation going on, but I think overall, what markets are somewhat forward-looking. I went and talking about the looking at the investments, the capital investments that are underway, all that stuff. Yeah, I mean that somebody's Todd's mentioning the all of the Defense Department investing in. There's a lot of money flowing out there. Years ago, I kind of coined the phrase that we live in a world of big numbers. Well, the numbers are getting bigger, and the flows that we see. I always said my job was to figure out the cash flow. If something's coming out, like a lot of people were talking about, there's a big rotation out of gold. We haven't done gold yet. I'll do that. Big rotation out of gold and went into Bitcoin because it rallied that day. And now gold's still been somewhat under pressure, moving down towards some of the key support levels. But there's not anything there that is, the best way to put it, I don't see that rotation. And, that's the big argument. I see Peter Schiff, my old buddy, starting to tell us that there's Bitcoin's going to collapse now that he's golden on the gold, and no pun intended. But yeah, so this is good. Let's go to Bitcoin, then let's pivot to gold, and just kind of keep flowing the best I can here. I usually use the BitSnap, but I'm going to switch this over to weekly because this is, I think, more important. There's some big Fibonacci numbers up here, looking at potential 170. 157. The min is 134. But here's the problem I have with Bitcoin. I'm seeing this when we first printed up over 100,000. What we print to here? When we first printed up here, the initial print was 104, 108, and then we printed up again, got to basically 110. And then we had this big decline down. I remember this was what I was talking about earlier, that you have the effect of, if you say something, this pivot number I had mentioned somewhere, 71,000, and we got pretty close to it. If it would have taken out 71,000, we were going to head down to 50,000. We'll just round it off. But it didn't happen. It held that number. And if I brought up the indicators, you can see the forecast around that time. We started to see everything getting forecasted to come up again. There was some, this is the weekly. there were some shorter term values, but when we were trading roughly at, let's see, 109, that's when these projections came up, or these fib targets came up. So, and it's interesting is Bitcoin's been fairly relative. We were just looking at Mr. and it's got some negative connotations, although looking like it's trying to bottom. But the key level is going to be here is the 40-week moving average, and that's we'll just call it 104. So if we get much under 104, then we could start to see some new projections. But if I look at the indicators, this is weekly, 21-week moving average coming into November is forecasting the potential for it to be a 0.61, which would be a full-blown downtrend. We don't have any downward targets or anything at the moment, but this the structure of the market is where I'm concerned, and but it's also kind of what's been going on. If we go back to this 24 consolidation, and then pop to a new high, another consolidation, pop to new high. But I want you to notice that each one of the after that second rally, that's been somewhat muted in the percentage. It looks like there's some distribution going on here right now. And I've also talked for a while that, people have been inviting in all the ETF guys and the governments even, to come in and adopt Bitcoin. And it's just not based on what Bitcoin is supposed to be, decentralized. Do you want the centralized folks or the governments and other regulatory people coming in? I guess maybe you have to have it, but to me, it's brought in a group of people, the arbitrageurs, a lot of the almost the opposite of Mr., where you're looking at the ETF guys are constantly just order flow and different types of strategies that you can do with arbitraging and all that, and that changes the nature of the market. Doesn't mean it can't go up, it can't go down. It just changes the nature of the trading and the flow of money around those instruments. And I just don't think those are great guys to hang out with in what Bitcoin, what it represents, air quotes on that. So where are we at in time? Yeah, it looks like market stabilized minus 20, right at 6,900. No big deal, up or down. Pretty typical volatility range. Yeah. So let me see what else is going on on the timeline here. Yeah, I think it's Gallup Flores figuring out what the catalyst for Bitcoin. I suppose it's entirely algo-technical. Yeah, it is, and I'm not truly I'm a technical, looking at it from a TA viewpoint, and from my metrics, I don't really understand a lot of stuff that goes on there. Maybe no one does. Michael Saylor seems to be the god behind it, but I'm not sure he even knows. Half the stuff he says doesn't make sense, at least to me. So let's do gold. I said we'd do gold. So weekly, I'll just bring up the peer view. I remember talking about these fib targets, and the upper fib target at that time was, let me just get to those, 3346, 3654, 3800. And of course, we blew right through that, right to the point where I was talking about the indicators, and is that they went to and closed above that orange line, and that's called an RTXL signal, typical that will mark the top of the markets, and then we get into what we're doing right now is we're going to get into this big bubble phase. So I'm going to draw in. Those of you who've been around the channel a while know this, what I'm about to show you. But here's what happens, even on the hourly chart that we're seeing on the let's see, on the hourly with this, what I call the bubble formation. So let me draw this in. Just want to get the colors right. Okay. So this is typical when you get this, pick the wrong color. When you start to get this orange line, I'll use this color. When it expands out, you get what I call an expansion. And if you look at Bollinger Bands, they use standard deviation numbers. These are more pure range numbers, extreme range numbers that come out, and then all the dots that are on the screen behind them are Fibonacci calcs. And then if you have the data sheet capability, it'll give you the ability which to bring up a probability of that. But here's what typically will happen from a pattern like in gold, is you start to see the market grid will start to contract, because what happens after the big volatility, the spike in volatility, then volatility collapses. I usually explain it as like a half pipe, right? So I'll have to get it. Let me draw this line. So a half pipe, oops, wrong. Yeah, just so you have, let me clean this up. So what happens with momentum is you get the half pipe, and then you have the ball. So, excuse my drawing with my mouse. But what happens with this is you set the ball, and then the first run up goes almost as high on the other side, and then it continues to from here, then it goes less and less until the momentum just kind of collapses, and then you get a move in the market in a direction, and that momentum expands and then it dissipates. So when you're in a trend mode, after a big trend like this, what will start happening is the ranges that happen each day here are going to be in this case, this is weekly, will start to contract and they get smaller. And then meanwhile, what happens is the market grid picks up on this collapse of volatility. And once it gets down to a certain level, then you'll start getting channels to build. I'm just making this up based on this primary algorithm here that is projecting some higher prices. This is at 21, but typically what will happen is you'll start to see the market grid start to set up a channel, and that will give you kind of the expectation. But the volatility has to collapse and normalize before you get to the next thing. Just like I'll just draw this like this whole section here. Right here, all this was doing was the normalization. So once you get the volatility, you get these big spikes in volatility and range volatility, then you consolidate, then you get the next trend. And this is what I was just talking about. You get this channel to build. The channel on this could be just the opposite of what I just showed you. And instead of going this way, it could start to form a channel that would go down, and maybe would come to this next volatility. But for now, you're going to be range bound, and that volatility has to collapse. And we could get a reset where we get another move down in gold or something like that to happen. and then that would set up more of a, there would be a whole reset in the thought. So the market grid's really good. I don't have the indicators up here right now. Hang on. So when we start to look at the indicators and start to look at the projections of the indicators, they're all telling us game over is what, this is a weekly chart. This is telling us game over. We're looking into January, February before this pattern's going to happen or change. And so what we could get is right now we still have very strong momentum. So this white line here, which is the 10-week moving average, is going to be where you can buy dips off of that line. If you're trading gold, you can play that line pretty solidly. But as we get down and we start to get into November and later, there could be maybe a lot of profit taking after a big year in gold. There could be other things, but it looks like we're going to get, some rotation, negative rotation, maybe end up down to that line I was talking about where you get down to the 40-week value, which right now is 3,400 and rising. But, we could be looking at, let me just get on this projection, like we'll say 3,600 could be the number where it finally stabilizes. So, I'm just trying to see the bottom of this one chart. I'm having trouble getting to the bottom. Yeah, somebody's asking, I have any idea. Why don't you make your question a little clearer? Yeah, Zappolo, I almost was living in Thailand last year. Almost moved there. Let's see here. Yeah, but yeah, it's funny. Somebody say I'm a skater. Yeah, so so gold, game over, maybe 3,600. Doesn't mean we aren't going to rally in between there. That bubble I was showing you is probably the thing there. Where are we at on time here, folks? We're 9 minutes out. Let's head over here. Let's do this. This is 1 hour. I want to go to. I've got on TradeStation up here. I've got a different line, but let's see if this plays out. This is kind of interesting. This is the red dots are projecting the price. This is a 1-minute chart. Let's see if that was interesting. We had a Fibonacci target up here at 69. Where am I at here? Yeah, around 20. Oh, I'm on daily. That's why. Apologize. So why aren't these numbers matching? Okay, here we go. That's interesting. Right up to the 200-minute moving average. So let's take a look at this. See if we get a rejection off of here. It's forecasting on 1 minute. We're going to get a rejection back to the 10, which is 19. We're trading 23. We'll see how this sets up. We'll just hang out with the markets and feel free to ask questions. That's an interesting comment. News short sellers blame retail investors for worst returns since 2020. Need more context. Yeah, thanks, Paul. I appreciate that. Yeah, it's been a tough time, so I appreciate it. It's the first time I've made anything public. She passed away in late August, so that was tough. It's still tough. Yeah, so Kay is saying that she's changed her WTR coefficient from 150 to 50. In certain circumstances, depending on the markets, yeah, that's why there's variables there. And that's also, Kay, why I need to get the Discord channel. Now, Discord channel is a private channel for those who own the indicators. And I'm going to be addressing that. So I'll be on Discord, those of you that are listening and have access to the Discord. We're going to be having some conversations on how to make that a really solid community that we can continue to build on. Yeah, so it was right. The algos were projecting down to the 10. Now it's suggesting the 21, which is down to 14. We're trading 20, so another 6 handles off. I'll tell you, folks, if you have these indicators and you put the market grid, the best way to learn quickly is to go to like a 1-minute chart. So every hour you get 60 bars. And you can watch the indicators function within a 60, as long as we've got a reasonable volatile day where they're moving up and down in, let's say, a 5 to 10 handle move. That's definitely what you want to watch for there. And you can learn a lot just looking at these short-term, how the algos set up, the projections, everything. It's like the best learning tool. That's where I learned so much going back many years ago, is the just learning through shortening the time range so you can see more and learn, because the patterns are the patterns. Just looking at some comments here. Yeah, so here's the issue. Somebody said, could you add SPX cash and NASDAQ data sheet to the daily newsletter? The issue is not me not wanting to do it. It's the Substack has limitations on how big you can make certain types of posts, and it has to do with an email limitation. And soon you're going to be able to generate them on anything you want. You'll find out. We're working on the project right now, so it's finally in production for you to sign up. It's going to be an app that you'll have at your availability, even through a typical like web app, or it might be on one of the websites that I have. We haven't figured out where it's going to be delivered, but you'll find out. So I'm pretty excited about that project, because I'm working on phase 2 of the project, which is I'm rebuilding a lot of the modeling with AI, what I call intelligence, versus just giving you a number to buy and sell. What we do right now in our WaveTech product, we give you the buy and sell number. We do give you a map of what the expectations are for that buy and sell, but I've built in some intelligence that will give you more of a, how's the best way to put it, that it'll give you probabilities and timelines when these things are going to be hit, rather than just saying, hey, the trade usually holds for 50 days and it makes 8%, 20%, whatever the number. It's actually going to give you more of a probability update as it sees new data. It's pretty cool. I've had that running for a while, so we're working on several projects. So you can see now we're on the screen, as we are seeing that those projections come into play here, where it's projecting up to this 1521 right now, which is 69, 19 level. Yeah, or 1525. So it's still looks like it's stabilized and start to forecast back up. And we're in what I call a sandwich between the 200 and the 40, this range. And you can see we're already starting to move up as the algos are pointing back up toward the 200. Where are we at? We got a minute and a half to go, so we'll just stay right here. Goliath. Okay, thanks. I appreciate it. Just notice I am way behind on the timeline. I apologize. Yeah, Kyle, that's what I use for scalping is the 1 and 5. Let me fix something here real quick. Give me a second, I'll see. I'm not going to get this set up in time for the close. There it is. Okay. So market just closed. So we came down to that line, then forecast up. We got that. Now it looks like we're going to, we got above the 200 minute. So it looks like we're just going to trade into that. All right, I come up on the screen full here. Appreciate everybody hanging out. We had probably 400 or 500 cumulative, so that's cool for not being online for a while. As far as the future goes, I would just, if you haven't subscribed, subscribe, hit the bell so you know when I come live. My plan is education and analysis, and ultimately, I haven't decided whether I'm going to start a new channel. I have owned the rights to something called the Rogue Advisor, and I kind of want to go through and challenge a lot of the, we'll just say, of traditional or some of these views that are out in the markets right now. I get pretty frustrated, even with like folks like Ray Dalio and some other folks. I will do a proper announcement. I think this new channel I want to start, I've got some potentially very interesting guests that all of you are going to love to see and hear from. And I'm just going to be the interviewer. I'm not going to have much of opinion. I kind of hate when you've got a guy like me that has reasonable knowledge and you bring on somebody and unless it's set up as a debate. There's always my buddy Hugh Hendry. I love the guy, but he's the intellectual type, and he's challenged me before to a debate. I'm not sure I'm up for a Hugh Hendry debate, but I'm up for a Hugh Hendry discussion. That we could have an open discussion would be fun. I guess I've kind of thrown barbs around a little bit, but I get frustrated with some of these views and folks that sometimes don't have, not necessarily Hugh, but don't have their money where their mouth is, that kind of stuff. So I always say there's no good opinions without money behind them. Anyway, folks, thank you again. Thank you for the kind thoughts on my family situation. It's been really, really tough. I appreciate everybody being patient with me. I did a video on, I think it was October 6th, that I was back, and I wasn't back. I thought I was, and so I'm not going to put that out there, but I will be doing some things on the markets. And like I said, I really want to focus in on the indicators. If you are interested in them, then I think I have this. I can talk while you're doing it. But this is how to get started. You can go visit it. There's an old video there. I'm updating all this stuff, but this is where you go. The KendallReport.com/indicators, and you can. If that doesn't come up right, I've seen issues where it doesn't. Just put a 24 at the end. So that is that's where you can go to get those and find out more. And then you get in the private Discord, and like I said, we're going to be working on some things as well. And just looking at everything that's on the timeline. Yeah, the Thailand, I see a Thailand for healthcare. That was why we were going to go there, but it didn't work out, unfortunately. I'll never know what the outcome will be. But any outcome could have been. Anyway, folks, thank you again. I'm glad to see a lot of folks coming back. I'm still working on getting life back together so we can move forward. But I am excited about the educational stuff. I really want to get on the Discord, so folks, look for me making some comments there. We'll set up some meetings and at least do some verbal meetings, and there's some great people in that community, so I'll continue to do that. Perfect timing. I have construction going outside of this place right now, so if you hear beeps, it's the trucks beeping up. Anyway, perfect time to quit. Thanks again, everyone. Please hit the like, subscribe, do all that stuff. It really will help me get back on and get the community going again. Look forward to talking to you soon. Look to Twitter, Kendall. I'm at x.portfolio expert, and there's no E in the expert. It's portfolio, and then just expert. And you can find me there, and I'll make sure in this video there's some things in the description that I'll have the links to the indicators and other things that you'll need to take a look at. Look forward to seeing you again. It'll be soon, not later. So thanks again. Appreciate it. Spent 2 hours and 27 minutes, so good time. Thanks a lot. That's it.